Welcome to Flippening, the first and original podcast for full-time, professional, and institutional crypto investors. I'm your host, Clay Collins. Each week, we discuss the cryptocurrency economy, new investment strategies for maximizing returns, and stories from the front lines of financial disruption. Go to flippening.com to join our newsletter for cryptocurrency investors and find out just why this podcast is called Flippening.
Clay Collins is the CEO of Nomics. All opinions expressed by Clay and podcast guests are solely their own opinion and do not reflect the opinion of Nomics or any other company. This podcast is for informational and entertainment purposes only and should not be relied upon as the basis for investment decisions.
Welcome to this two-part deep dive on cryptoasset staking, staking as a service, and on the topic of how to use staking to generate returns for your portfolio. My guest today is Joe Buttram, founder and CEO of EON Staking. I was introduced to Joe through a previous guest, Katia Kovalenko, and you can learn more about her in episode 36. During a pre-interview with Joe, I was blown away at just how deep the staking rabbit hole went. I was expecting for this interview to take anywhere between 45 minutes and an hour, and we went almost 2 entire hours. In this episode, we explore staking as a service and how proof-of-stake consensus mechanisms offer a completely different paradigm for operating blockchains and also generating returns. This two-part deep dive on staking is broken into 4 chapters. In Chapter 1, we explore what staking is, and we discuss a step-by-step process for doing it with tokens that you might be holding. In Chapter 2, we discuss the ins and outs of staking as a service and what that looks like, also what that looks like as a business model. In Chapter 3, we consider the regulatory landscape around staking and consider how the IRS, FinCEN, the SEC, and the CFTC view staking. And as a side note, I should tell you that this is the most extensive review on the regulation around staking available anywhere online that I've personally seen. Finally, in Chapter 4, our last chapter, we peer into the distance and see what the future of staking and staking-based blockchains looks like. We'll get right to this episode in just a second, but before we get started, I'd like to pause for a moment to tell you that this episode is brought to you by Nexo. Here's a word from them. Nexo is the world's largest and most trusted crypto lender, offering automated instant crypto credit lines, which allow you to use your crypto, for example, Bitcoin, Ethereum, XRP, etc., as collateral to get cash in over 45 fiat currencies and stable coins. And you can do this without having to sell your crypto assets. Nexo also offers interest earning accounts yielding up to 6.5% per year for stablecoins and euros. Interest is paid out daily, and you can add or withdraw funds at any time. Nexo is also a strategic partner of exchanges, OTC desks, traditional and crypto funds, helping them earn interest on idle stablecoins and fiat. The company's growing portfolio of structured institutional products includes fully collateralized, continuously rebalanced swap agreements, allowing counterparties to effectively manage their balance sheets. Check them out at nexo.io. And thanks to them for sponsoring this content and making this content possible so that you can consume it for free. This episode is also brought to you by the Nomics Crypto Market Data API and CSV Export Service. If you need an enterprise-grade crypto market data API for your fund, smart contract, or app, or if you need historical CSV dumps of trading data from top exchanges or even obscure ones, then consider trying out the Nomics API or our historical data export service. Our API enables programmatic access to clean, normalized, and gapless primary source trade data across a number of cryptocurrency exchanges. Instead of having to integrate with multiple exchange APIs of varying quality, you can get everything through one screaming fast fire hose. If you found that you or your developer have to spend too much time cleaning up and maintaining data sets instead of identifying opportunities, or if you're tired of interpolated data and want raw primary source trades delivered simply and consistently with top-notch support and SLAs, then check us out at nomicsapi.com. Or if you'd like to order historical cryptocurrency market data as CSV exports from top exchanges, email us at sales@nomics.com. Okay, back to our regularly scheduled program. Here's part 1 of my conversation with Joe Buttram from EON Staking. Enjoy. what was the journey that you took to go from someone who heard of blockchain and Ethereum and Bitcoin at some point to starting a service like EON? What was that path like?
I first heard about Bitcoin in 2011. I was just kind of, going and surfing the web and, reading about a lot of interesting different things. Ran across the Silk Road at that time. And it was obviously very intriguing that there was this, marketplace where people can buy and sell pretty much anything. As I kind of looked into that, I saw that they were using Bitcoin as like their payment solution. And it was very interesting to me, but it didn't necessarily click as how big and powerful sort of the blockchain was and could be. With that said, in 2012, a year later, I worked for the Ron Paul campaign. And so I basically got indoctrinated into the whole, end the Fed sort of thing that he was proposing, and just generally learned a lot more about monetary policy. And, coming of age during that time, QE was in full force. It was very obvious to me at that particular time how it was changing, the economy.
Hey, this is Clay cutting in here from the editor's booth to define QE. QE stands for quantitative easing, which is a monetary policy whereby a central bank buys predetermined amounts of government bonds or other financial assets in order to inject money directly into the economy. This, of course, creates inflation. Okay, back to Joe.
With that added life experience, when the big first bubble of Bitcoin happened in 2013, 2014, I saw it again at a much higher price. And I was like, okay, what's going on? And with that knowledge I accrued during my time at the Ron Paul campaign, when I dug deeper into Bitcoin, I was like, wow, this is super important, potentially really big. From there, I was trying to figure out the best way to get involved. At that time, it was a lot of the narrative was the blockchain, not Bitcoin. And I thought most of the magic of this stuff was on the open source side. And so basically got my start on the community level, helping my good friend Grant Hummer throw the first Ethereum meetups in San Francisco. And from there, just got to know the teams and know the different projects and see what sort of technologies were promising in the space. As the markets started taking off in 2016, 2017, I was actively doing a lot of investing in these projects that I identified early on as something that could be very interesting. So that transitions me into EON in that I was doing a lot of deals and stuff, trying to get in on these good projects the climate was in 2017. And I was really taken aback. And I mean, that was the environment, but basically, there were large, syndicates that were just on chat rooms sending around tens of millions of dollars, right? And I very much realized that this is probably not the safest and best way to do things from a legal perspective. And obviously now during the bear market, we're seeing, a lot of the blowback from that. But as I was searching for a more buttoned-up way to do these sort of deals, I ran into my current partner and co-founder of EON, Santiago Raul Santos, early on in the basis deal. He did a great job putting together the SPV that I was going to go into. From there, we started going back and forth on a lot of different investment opportunities. And as we started investing more and more over the course of a year, we realized, wow, all these projects we're very enthusiastic about have proof of stake coming. And, there needs to be a solution on the market that is really buttoned up, to potentially manage, billions of dollars. And so we decided that we wanted to do that after we really took a deep dive into what the market could look like. And that's how we came here to EON, and it's going in full force now. And it's been a very interesting experience in this brand new market that's emerging.
What year were the first Ethereum meetups in San Francisco?
So I believe in 2014 and 2015, most of the meetups were happening in Silicon Valley by Chris Peel. And I used to go to those a lot. And me living in San Francisco, I would commute down and really was attracted by the opportunity to do it in SF. And Grant beat me to the punch a little bit by setting everything up first, but I immediately was ready to help him. And so the first meetups were, I believe, December 2015 in San Francisco.
You also mentioned an SPV. Hey, this is Clay cutting in here again to explain what an SPV is. SPV stands for Special Purpose Vehicle, and it is an entity that allows for making very focused investments without compromising investment restrictions that a parent entity might be beholden to or creating liabilities for the parent entity. Usually SPVs are used for securitization purposes, and they're allowed to finance, buy, and sell assets. Okay, back to the show. Was that an SPV for raising capital for EON?
It was just to syndicate, investments into, ICOs that were coming onto the marketplace. A lot of the deals that I was seeing on chat rooms and stuff were, pretty much just, here's my address, send me money. And the SPV was a very nice way of, covering our bases legally and contractually.
Oh, got it. And that was during the ICO craze of like 2017, 2016. Is that right?
Exactly right.
Oh, those were the days.
Yep.
I am not surprised that, you heard about Bitcoin, but it sounds like really sunk your teeth in the space through Ethereum. It does seem like there's a kind of person that's drawn more to Bitcoin, and there's another kind of person who really wants to get involved. They want to write some code. They want to get their hands dirty, and sometimes it can help them take their mind off price movements. Did you find yourself drawn more to Ethereum and that community than more of the Bitcoin community?
I mean, I'm not necessarily a maximalist one way or another. I would just say that, Bitcoin, the magic of it is that the parameters are very hard set, right? Like everyone knows what Bitcoin is, and you don't variate too far off from the core features of it. And while that is very important to this ecosystem and the world, I gravitated towards Ethereum and some of these other projects because of, the potential venture style plays that it could enable with, all the cool things like, global computer and that sort of stuff.
I guess we've learned a little bit about your background and how you came into the space. What was the transition from being involved in the, in the Ethereum community to saying, hey, we're going to start EON Staking? Was there a spark? Were you staking on your own and seeing nice returns? What made you decide that you were going to throw everything into this and make this a full-time endeavor?
So I wouldn't necessarily say there was one particular thing. I would say it's a combination. One is just, as I mentioned, I just held assets that needed to be staked because I wasn't necessarily, short term on any of these projects. So I was like, okay, I don't want to get diluted away, so I'll need a solution. So just for my own personal needs and my own problems, that was, the first thing that got me thinking about it. On top of that, I really liked, being able to contribute to the networks and help the founders and everything like that. Because generally, just by the nature of, doing the deals and, communicating with them and trying to be a value add partner, we had close communication with a lot of these folks, and they were immediately telling me that, hey, we need help here. Would you be able to stake, your assets? And, they were reaching out for us to do that. And so I identified that need as well. The next thing that really kind of solidified it in my head amongst the other, as well as the other two, is block producer debate that happened for EOS when they launched. It wasn't necessarily a debate, but it was highly competitive. And you can see that there was a real powerful market movement and concentration and focus on that particular feature of the network, which I thought was extremely interesting and kind of validated sort of my thesis that, okay, this could be a big thing.
Are you bootstrapped or have you raised some venture capital money? What's funding you right now?
So today we're completely founder funded. The nice thing about staking is that it's the operating margin and the upfront costs, they're pretty efficient. It's not like proof of work where, the more hash power you need to aggregate to mine more blocks, you need, more electricity, more hardware. There's not necessarily those economies of scale. So we're able to keep the operation pretty lean to date.
Joe, let's kick off chapter 1, which is a primer on staking. For those who have heard of staking, or maybe they've done a little staking on their own, but really haven't gotten the 360 on what staking is, how would you describe what is staking, how it exists as a competing or alternative model to proof of work?
I usually tell people that are, not intimate with crypto or brand new to that part of the space is just, it's the new form of cryptocurrency mining that's coming onto the scene. And to dive a little bit deeper into that, essentially the main differences is that instead of in proof of work having to solve an arbitrary algorithm with hash power to, hopefully win the lottery of sorts to be, the highest and best output of hash power to obtain the rewards and the ability to mine a block. Instead of using that electricity and that infrastructure and those machines, instead you're backing that proposal or that ability to go and capture those rewards with the tokens themselves, the native assets. There's a process involved with that called validating, in which you have to sign transactions. That, at its core, I think, is sort of how I split the two.
I personally have heard a lot of criticisms of proof of work. It's expensive. You have to purchase a lot of hardware that isn't put to very good use. There's there's environmental cases against it, and on and on and on. I think we've heard criticisms of proof of work, and some of them are good and some of them are not. What do you think are some of the best criticisms of proof of stake?
I think the best criticism of proof of stake is the centralization of voting power to large token holders. So while I do think that is a step better than exogenous players in proof of work, when governance comes into play, that could add some complexity and some trickiness to the system. So that one I think is very true. But that being said, we're seeing interesting workarounds and proposals people are putting out there to sort of solve that problem. That's the biggest one, I think.
For people who are kind of new to the space, what are some of the more popular stake-based blockchains where staking is securing the network versus proof of work?
Well, there's many different flavors of proof of stake, but the ones that are just like pure proof of stake in the model that we'll probably get into at some point, we're finding that Tezos is probably the leader because they were the first on the scene to really implement it in a big way. In big way, I mean by like large market cap and awareness via their ICO. Decred is also very, very good. They have a hybrid proof of work, proof of stake model. They've been working very well, and that one is very popular within the community. Now, Cosmos is live, and that one is definitely getting a lot of traction and really bringing staking to light.
You mentioned EOS before and block producers. Is EOS not a proof of stake based blockchain?
So it's DPoS. So it is a proof of stake sort of system, but instead of users depositing their tokens to obtain rewards, they use their tokens to vote for a block producer, and the rewards payouts are kind of done in a fashion that they decide at the end of the day. It's just a different type of proof of stake.
You said DPoS, so that's for the uninitiated. That's delegated proof of stake. Is that correct?
Right.
Yeah. Okay. So that's a little bit more like maybe more analogous to a representative democracy like we have in the United States, where you vote for a congressperson and that person votes on your behalf, versus like a direct democracy where you're voting on specific issues yourself, maybe like the California proposal, state proposal system. Is that an accurate characterization?
I mean, there's obviously not a lot of nuances between the two, but we see that comparison brought up a lot. Yeah, so there's a lot of similarities for sure.
What other popular proof of stake blockchains might exist? Like is Cardano a proof of stake based blockchain?
Yeah, so they are planning to migrate to their proof of stake system called Ouroboros pretty soon, I think. They currently aren't running live on proof of stake, but it's definitely within their plans, and they've done actually a lot of work on it, and it's a very interesting sort of schema that they've put together for it.
Right, and then potentially Ethereum as well, maybe yeah. 20 years from now.
They just launched their testnet phase 0 validator system, so we'll see. I mean, that was one thing I was thinking about Cosmos for a bit, but people were upset that Cosmos was, taking a long time to launch their blockchain. But, these are really hard problems with lots of value in them. So it makes sense to take the time. But Cosmos eventually did it. I can totally see ETH, shocking everyone too and delivering early as well.
What are some of the economic models around staking? Can you pick one or two blockchains and talk about how, what someone might do end to end to begin staking, starting with buying the currency and then what comes next? How do you get up and running if you want to participate in the security model and earn some revenue doing this?
I'll use Tezos as an example. How do token holders earn rewards? So essentially you obtain the token, whether you participate in the ICO or, you bought it on an exchange. You at some point need to basically regain custody of that asset. So if you bought it on an exchange, you're going to have to, if the exchange doesn't offer a staking service, you'll have to basically repatriate the assets back to yourself. in a wallet. And then from there, you use generally a native wallet that has a delegation feature in it. A common one that people use is Ledger, or a web wallet is Tezbox. And they have this function in their UI, which basically allows you to send a message to the blockchain called a delegation transaction, which essentially gives your rights to vote for blocks to a validator of your choice. And in order to do that, you have to pick a validator. And so that's one of the big things I think that goes into the thought process of a token holder looking to delegate and participate in proof of stake is finding a validator that fits their profile. And there's a lot of different methodologies that people are using to date. A lot of it is price based. So some people, all they care about is just what's the lowest fee of the validator. Some of them are very into the security and the technical operations and excellence of that validator. So are their uptimes sufficient? Have they ever had a slashing event? Those type of things. And then we're seeing more and more, there is, especially with these governance protocols, and we're seeing this in Tezos as well, but there is sort of an alignment between the validator and the delegator that needs to happen in terms of a constitution or, some sort of thought processes in how to vote and the integrity that the validator has to, go and vote on proposals to upgrade the network.
So step one, buy the cryptocurrency. So we're talking about Tezos. So Ledger is, you can move it to Ledger, or what was the name of the web wallet that you mentioned? Was it Tezbox, did you say?
Yeah, Tezbox. Tezbox is I think, the most popular for Tezos.
Maybe this is the next kind of thing to unpack here is, who are all the players? You've got the token holder. You mentioned a validator. What is a validator?
A validator is somebody like us at EON that essentially votes on blocks and aggregates voting rights from delegators to earn rewards for the delegators, as well as to add new transactions to the ledger.
Joe, what's the role of a validator in a non-delegated proof-of-stake system? If the corollary here is direct democracy, why are votes being aggregated?
Votes are being aggregated because stake needs to be put into the voting of new blocks, right? So basically in proof of work, you're using a bunch of hash power, and the whole thing is proof of work, in which you're proving that you're doing all this work, which means you value that chain and that asset, right? In proof of stake, you're essentially ensuring the integrity of your voting of new transactions and new blocks by putting up stake, which is the native token.
The validator is backed by the tokens, which are associated with it by virtue of staking. And that is sort of equivalent to hash power in a staking system. How does a block get created with a proof of stake system?
It depends on the proof of stake system, but generally people are, transacting on chain. Let's say they're just moving tokens around, and they have to send a signed message from their wallet to a mempool, which is sort of like the queuing period for all these transactions. And generally in proof of work, and this is similar in the majority of proof of stake networks as well, the validators or the miners in proof of work, they sift through that mempool and pick which transactions to be included into the blockchain.
How is it determined which validator gets compensated for creating the block? Is it somewhat similar to proof of work?
There are some similarities. Probably the biggest thing is how much stake you have. Again, it varies on network to network and all the different flavors of proof of stake. But essentially, the more stake you have delegated to you, the higher chances you have of validating a block. And oftentimes, at least in the majority of the large proof of stake protocols currently out in the wild, there is a lottery system which sort of picks all the different validators, and you have a higher chance of being selected the more stake you have.
The number of tokens that back a validator is somewhat analogous to the amount of hashing power behind mining in a proof of work system. And the more tokens backing a validator, the more likely it is that validator is going to mine a block and that it can return tokens to the people who are backing that validator. It's kind of like a mining pool. Okay, so you have some tokens, you have some Tezos, you're using something like Ledger, or you're using something like Tezbox, or you're using EON Staking. And what happens from there? Is there any way to sort of approximate what your return is going to be? Do you have calculators for that kind of thing? Like if, I guess for someone who doesn't have a lot of, bandwidth for calculating things, are there any kind of rules of thumb? Is it sort of, should you get returns that are like roughly the same as inflation over the course of a year? How do you think about returns and explain it to the layperson?
Overall, it's pretty straightforward, but one of the interesting sort of dynamic factors to take into account when you are modeling those things is the inflation rate on these proof of stake networks changes depending on how much of the entire supply is staked at any one point in time.
Hey, I wanted to pause for a moment to let you know that this episode of the Flippening podcast is sponsored and brought to you by Nexo, who believes in the value of making this kind of education possible. So if you enjoyed this content, you can thank Nexo for their generous support of the work that we do here. Here's a word from Nexo. Nexo is the world's largest and most trusted crypto lender, offering automated instant crypto credit lines, which allow you to use your crypto, for example, Bitcoin, Ethereum, XRP, etc., as collateral to get cash in over 45 fiat currencies and stablecoins without having to sell your crypto assets. Nexo also offers interest-earning accounts yielding up to 6.5% per year for stablecoins and euros. Interest is paid out daily, and you can add or withdraw funds at any time. Nexo is also a strategic partner of exchanges, OTC desks, traditional and crypto funds, helping them earn interest on idle stablecoins and fiat. The company's growing portfolio of structured institutional products includes fully collateralized, continuously rebalanced swap agreements, allowing counterparties to effectively manage their balance sheets. Check them out at nexo.io. Again, that's nexo.io. And thanks to them from the entire Flippening team and our audience for making this education and this content possible. In addition to Nexo, this episode is also brought to you by the Nomics API and the Nomics CSV data export service. The Nomics Market Data API offers squeaky clean and normalized primary source trade data offered through fast and modern endpoints. If you're a professional investor or developer, you need accurate prices, and I can tell you that our competitors' prices are not accurate. We're actually going to come out with a report about this soon. I should also note that the Nomics API is used by many of the largest and most influential companies in the space, including top exchanges, $100 million plus AUM funds, and prop shops. Hit us up if you'd like more details or go to nomicsapi.com. Furthermore, if you'd like to order historical cryptocurrency market data as CSV exports from top exchanges, email us at sales@nomics.com. Okay, back to the show.
There's a general consensus that 2/3 is of the assets staked, of all the tokens. That number roughly is the best to ensure the highest level of security in most of these networks. And so I'll take Cosmos as an example. Their inflation rate fluctuates anywhere from 7 to 20%, depending on how much is staked at any one time. So if a full 2/3 of the entire network is staking, they would reach the optimal rate of 7%. But the lesser of 2/3, the higher the inflation goes. And so there are calculators and models out there. There's a lot of open source tooling for that people can, just simply Google and pop up. A lot of different validators also provide it. We do as well. But that's the only thing I would have to say that takes a little bit of extra math. From there, you basically are looking at how much tokens you have, and based upon that fluctuating inflation rate, they can then deduce how much rewards they should expect over the life cycle of their staking.
So there are very few financial products or paradigms in finance that are truly net new. Do you think there is a corollary to staking in the sort of the pre-blockchain financial world or not? Like, does staking have a history that predates blockchain?
I think it definitely is an extremely novel and new economic experiment. There are some corollaries between different sort of assets that are, pre-blockchain. There's potentially, some crossovers between fixed income, potentially structured products, potentially just looking at, a reserve currency of a sovereign nation and, the inflation that is created by the central bank. So I think there's obviously a whole bunch of new features in proof of stake that are, dedicated to, the blockchain realm, but it's definitely taking a lot of these economic theories and models from traditional finance as well.
Is there a specific fixed income product that you think this looks most like or not?
It's not a one example in anything particularly, but I do think, there are some similarities to treasury bills and bonds and also loans. Basically, if you're going long on a currency in, some sort of emerging economy, you decide to buy a bunch of that native fiat, the central bank is most likely going to be, printing money to do various central banking. And with that, you're probably going to have to figure out a way to hedge the inflation, potentially being able to, acquire a T-bill or a bond, something that could be sort of similar. But obviously, this is something that's native and automated to the network. But that's something that comes to mind as I think about staking.
How would you compare the risk profile of proof of work versus proof of stake? Let's say you have $100,000 and you're looking to invest in proof of stake versus proof of work. How do you think they compare?
I think there's a lot of really interesting nuances when you compare, investing in proof of stake versus proof of work. The immediate things that come to mind when it comes to the risk profile of proof of stake and what a lot of our clients, particularly hedge funds, communicate with us is the risk of slashing. Most of these proof of stake networks, because you are essentially using your tokens as collateral to be able to sign blocks and to be doing it honestly. If you do it dishonestly or you make a mistake, the protocol slashes or reduces your principal. So that is something that a lot of our clients think deeply about when they think about just purely staking for one or two investing in proof of stake networks. And so each network has a different sort of structure for that, but that is certainly a clear distinction between proof of stake and proof of work. To be more positive on proof of stake, I think one of the cool things about proof of stake, if you're thinking about investing in that specific infrastructure, is for proof of work, there's a significant amount of upfront costs. And if you don't mine a block, that electricity that you spent on, you can't recover. But with proof of stake, the assets that you're acquiring to participate in that consensus mechanism and earn rewards is liquid. So you'll be able to, efficiently, use your upfront capital and trade in and out if you ever decide to change the course of your strategy. So there's a lot of cool things in proof of work and proof of stake as, different sort of profiles for investors and users to think about. But those are some of the two that I think about a lot.
One of the things that you said to me during our pre-interview that really stuck out or struck home was that there has never been before algorithmically dictated like returns that are programmatic and somewhat guaranteed, like with proof of stake. Can you go into that a little bit more?
I would say that proof of work, definitely, every block you expect someone's going to get paid a reward. But in proof of stake, now this is more accessible to the individual token holder. What I was kind of leaning towards is if you're trying to get involved and, you want to buy $100 of tokens, now you have, the certainty around, the rewards and your efforts and inflation. Something that is seen in other markets like fixed income and other things, but it's never been programmatic, right? So I think while with fixed income and real estate and these other things, it's always, over time, a lot of the risk gets hedged out via different operational efficiencies and whatnot. At the end of the day, this is a protocol that's running on code. And so it really reduces sort of that risk profile when you're thinking about consistency of rewards and payouts. So I think that's something that's going to be leveraged pretty heavily as we see the proof of stake market start, continue to evolve. The ability for people to, have certainty around those rewards. It's really novel and it's something that I think we've only really seen when it comes to, the cryptocurrency space, but more particularly now for the common individual staking.
I guess I'm trying to get a sense of like, what is the reliability and the consistency of returns with a proof of stake system? I mean, can you just assume that like, given a long enough time horizon, if you put up a certain amount of tokens for stake, and you are with a validator who is not breaking the rules and going to get your funds slashed, that you can expect a certain rate of return of the asset. Now, of course, the asset might depreciate in value or increase in value, but if you're sort of thinking purely of returns in a given asset, can you just come to expect a certain rate of return, or is that not realistic?
There's a lot of effort to get to that point where you can, expect to a high degree of confidence that you'll be getting those rewards, on sort of like a fixed schedule. I would preface it to say that one thing that we can guarantee for sure is that somebody is going to be getting those rewards, right? And so it really just, yeah. So from there, I would then extrapolate as to like, okay, like, are you doing the right diligence? Are you putting in the right efforts to make sure you're part of that group? That's how I would say it.
Are there legal reasons why you can't say more definitive things? I imagine your attorney doesn't want you saying that like a certain amount of return is guaranteed, because it's probably just a lot more complex and nuanced than that.
There definitely is some legal reasons behind that, but there's also just very much like the truth of the matter. There's a lot of people that I'm sure are sort of sitting back and it's like, oh yeah, so easy. I'll just go ahead and, just place my tokens over here with this validator and it's all hunky dory. And then they check, a year later and they're like, wait, this is not, the rewards payouts that I was expecting. And we're seeing that today. So I think it's just a matter of fact.
What were the first couple of crypto assets or networks that used staking? I know you've mentioned Tezos, but I'm guessing Tezos was not the very first to pioneer this concept. What were some of the early pioneers of this space?
The very first cryptocurrency that sort of applied the concept of proof of stake was Peercoin. So I think this was in 2013 around then, but they had a very limited sort of rollout of how staking would work on their platform. That was like very much the first. From there, we saw different projects look into it a little bit more deeply, most notably Ethereum. Vitalik has been thinking about proof of stake for a very long time. So that the idea has sort of been, floating around and worked on for a good bit. I would say in production, the one that I think got a lot of traction with a proof of stake model is Decred. There's very much a dedicated community and a sufficient market cap at this point, which really validates that, okay, proof of stake is like a real thing when it comes to that network. And that was sort of the first one to me that really came to prominence. And so we saw many different iterations and variations as well. I actually credit a lot the Dash team with their masternode setup. Granted, it's not pure proof of stake on a consensus layer, but there was, their masternodes basically allow for people to stake or deposit their tokens to perform some sort of on-chain function in order to earn a reward. Those are some of like the early ones that I think about when you bring up that question.
So Peercoin as maybe the first kind of pure proof of stake, but doesn't have widespread adoption in production. And then Decred and, maybe Dash as examples of hybrid proof of work, proof of stake. Is that a fair characterization?
Yeah, I would say so.
Moving on to chapter 2, staking as a service. So maybe a good place to start here is the value proposition. So you mentioned with Tezos that if you have a ledger, you can stake your tokens, and you could also use something like Tezbox. What is the value add to staking as a service and a platform like EON?
If you're a token holder and you don't necessarily have the technical capabilities to run the processes yourself, that's immediately the first thing that I think people lean towards as to why they use a staking as a service provider. With that, there's also, even if you were to run it yourself, there's also high degrees of technical complexities that are essentially revolve around slashing and uptimes that even if you were to run it yourself, do you feel confident enough in your abilities to make sure that you don't screw that up, right? So even if you can just spin up nodes, and we see a lot of people do at a certain level, you're going to have to think about, okay, is my setup secure enough? And so that's another reason people move towards staking as a service. But there's a lot of different reasons for it. Another one is tax. A lot of people, particularly hedge funds, aren't necessarily structured to do it themselves due to unrelated business taxable income. They, essentially have to use a service provider because it's not necessarily within their original structuring. I would say that the first two I mentioned were the most pertinent, which is technical complexities and the high risks of doing it yourself. But Another thing to add as well is a lot of these blockchains, they have minimum capital requirements to become a validator. In EOS, in order to become a block producer, you have to be a top 21 block producer, which means at least, I think at these levels, this market cap, at least $120 million. And for Dash, for instance, in their masternodes, you need at least 1,000 Dash. And in Cosmos, it's 100 validators. And in Tezos, they're actually quite a bit on that platform. But there is a role requirement where you need 10,000 Tezos. So, if you're a smallish sort of token holder, you may want to leverage the economies of scale of a third-party service provider like us.
Is another reason why someone might go to you is because maybe there are custody requirements that a hedge fund might have, or a family office, in order to show that they're doing things correctly, that sort of sending things to a value-added custodian is probably a good way to go, since they do custody most of their assets anyway, to kind of have this as a sort of an additional thing that a custodian provides. Is that another reason why someone might use you guys? Are you guys officially a custodian?
I think an important thing to note is, particularly when it comes to staking, there is a paradigm shift in regards to custody. So in most of the proof of stake networks that are out there, you actually don't have to give up custody of your tokens to a service provider or a validator. The delegation transaction that I was mentioning is just a signed message from your own wallet with your assets, basically giving the voting rights to a particular validator of your choice. Yeah, that's we don't take custody. We're delegation only at the moment. But we've been talking to a lot of the big custody providers out there, and it is becoming clear that this is going to have to be a value-added service that they implement in-house. Because, I would say back to your fund question or your family office question, there is, with staking, it brings up a lot of interesting fiduciary responsibility questions. There is a 20% inflation rate on the asset that you're holding. Are your LPs going to be okay with you not going out and ensuring that, you're able to hedge and not reduce your positions, right? So all those kind of things kind of fit into your question.
I didn't know that you guys didn't take custody. I just assumed that was part of the deal. So let's take the example of Tezos, which we've been using. What would you do to assign, to give your voting rights over to EON? Is there like a smart contract you have to execute? Is it something that's just in every single wallet that's pretty easy to do out of the box and the UX is good? How complicated is it to actually do that?
It sort of depends on the client that you're using, but the majority of wallets that are out there have that delegation feature within that wallet. So on Ledger, you can go and delegate. On Tezbox, you can go and delegate. Once you basically take custody of your assets, it is a pretty seamless process to have your rights be delegated to someone else for voting.
What else is part of what you guys do? So you validate blocks. Do you provide interfaces around voting on particular proposals and such?
In our rollout of our B2C platform, basically, there'll be a easy way when it comes to a new proposal that people need to vote on, that they can go and interact deeply with that decision and let us know what they'd like to vote for. On a lot of different of the proof of stake networks out there, if the token holders are passive and don't vote on anything, we end up becoming a proxy where we basically, any votes that the token holder doesn't use to vote on new proposals, we have to make that decision on our own. So that's another service that if a token holder doesn't want to necessarily constantly be looking at the upgrades and all the different sort of proposals that are out there, they can outsource that to us potentially.
Does voting versus not voting affect the return profile? Are you required to vote in order to earn a certain amount, or at least to delegate your voting to someone else in order to earn rewards?
Not particularly, but there could be a scenario where there's a proposal in which they're interested in either increasing or decreasing the inflation rates of that network, which would adjust the expected rewards that a token holder would accrue. So on its surface, no, but there could be instances in the future where it does cross over.
In most of those instances, I imagine it would behoove whoever is staking to vote for more inflation. Is that correct?
Potentially. I mean, a lot of people are very averse to, too high of inflation, which totally makes sense. It's a community vote at the end of the day. So it just depends on what the constituents want.
So governance And proof of stake, although they are related, voting is not required in most instances to generate a return. It's simply enough that you're staking the tokens and using that to validate blocks.
Correct.
What is the history behind staking as a service? Are there any corollaries, again, in the pre-blockchain financial world to what you do?
There are some analogies out there that, we can potentially point to. I think a very interesting one is being a proxy firm for equities. Just the same thing. If you're a shareholder and you have voting rights, or if you're just a small shareholder and you want to join a bigger class, that's something that we see in traditional markets that looks sort of similar. In terms of the history, in terms of staking in the early days, a lot of it was just people spinning up nodes, and it's been interesting to see over time how it's become more professional and also with the stakes, no pun intended, getting larger and larger. There definitely is a lot of focus that's been happening on using these service providers.
It was news to me that you did not have to take custody of these assets. So I guess that brings me to think a little bit more about trust and where your customers need to trust you and where they don't. So we've established that they don't have to trust that you won't run off with their assets or that you won't be hacked. Where do your users need to trust you?
I think what every delegator should think about when they pick a validator is what's their technical excellence like? Are their uptimes sufficient? I'd say 95% plus, 96, 97%. Have they ever had a slashing event? I think at the very minimum, that's what people are really going to have to look towards is technical competency. In terms of the other trust verticals, especially if you're relying on a validator for voting, you're going to have to see if you're in line with their values. So that's a big one. But as a whole, because, you don't have to take custody for a lot of these networks, it does sort of change the dynamic of the attacks. That being said, it's not to say that, a validator isn't at risk either. It's pretty interesting because, what are the situations in which a validator would get attacked? One that comes to mind is other competing validators as well. So, if you're validator number 10, you want to be validator number 1, instead of going to market and essentially campaigning for, your delegates to trust you and, to build all this BD and all these, value add products, doesn't make sense for some validators to go and try to get others slashed. And we think that's going to happen at some point at a high level. So there's that. And then also, if there's a big slashing event, that could potentially affect the market and people may want to, use margin to short or something like that. So it's not necessarily risk-free to, be a validator in the security aspect of things. Those are some of the aspects that we think about when it comes to, our operational excellence and, some things that delegates need to think about when they choose and trust their validator.
Well, that wraps up part 1 of my conversation with Joe Buttram from EON Staking. I hope you'll join us next week for part 2, where we discuss the regulatory landscape for staking and hear Joe's take on what the future of staking might look like. Before you go, however, I want to mention that since we've started producing episodes at a much higher rate, we now have room for a few more sponsors. If you like the work we do and would like to support this show, then a sponsorship might be a good fit for you. I can say from our own experience that Flippening sponsorships absolutely work. Each and every time we put out an episode of the podcast, we mention our own API. And to date, every single one of these advertisements has resulted in at least one customer. In fact, we would do these shows even if nobody else sponsored because of the business it brings to us. And over 80% of paying customers mentioned that they heard of us through our podcast. If you're interested in sponsoring the show, please hit us up at support@nomics.com. All right, that wraps up things for this week. Stay tuned for next week's episode, which is part 2 with Joe on staking as a service, and generating income with staking. Until then, take care.
That's it for this week. To sign up for our free crypto investing newsletter, listen to other episodes, or get the show notes from this episode, please visit flippening.com. I also invite you to check out the startup that funds this podcast, Nomics, spelled Nomics, at nomics.com. Finally, if you got value from the show, the biggest thing you can do to help us out is to leave a 5-star review with some comments and feedback on iTunes, Stitcher, or wherever you listen to podcasts. Thanks for listening, and see you next week.